Hey, welcome investors to the 40 Finance channel. As most of you know, I'm very bullish on buying the dip in the QQQ right now. But with that being said, there's certainly a lot of risks out there for the stocks that are within the QQQ. And with that in mind, I've been researching some potential hedge opportunities if the supply chain and inflation and things don't go down like I'm expecting to here in the second half of 2022. And one name that pops up time and time again as I'm reading through headlines is Berkshire Hathaway. So for this video, we're going to look at Berkshire Hathaway, the B shares, by the way. I'm in no position to purchase A shares on this one. But we're going to look at Berkshire.B as a potential hedge for QQQ and see if it makes any sense. Okay, let's jump in by looking at the holdings of Berkshire Hathaway, and CNBC has this Berkshire portfolio tracker you can find on Google, and this has been updated to include the Occidental Petroleum purchase on March 16th. However, in terms of today's headline, here on Monday, the Alleghany deal is not going to be included in here, I think namely because that's not going to even close until Q4 of 2022. And if we scroll down, we got this great little table I sorted by the percentage of portfolio. And if you follow Warren Buffett, you know that Apple is the #1 position at 43%. So stopping right there and thinking about a hedge for QQQ, Apple also happens to be the highest percentage of the QQQ at the time of this video, coming in at around 11% of that fund. All right, next up we have Bank of America at 13%. That's obviously not represented in the Qs. American Express, 8.5%. Coca-Cola, 7%. Kraft Heinz, 3.6%. Oxy, Verizon, that is a member of the Qs. US Bancorp, Moody's, Chevron, DaVita, Kroger, VeriSign. So just eyeballing the list here, and let's just call it the top, 60, 70-ish percent of the holdings. You really only have a couple names that are even in the Qs. And from a hedge perspective, you've got some things that, frankly, I would never buy. In a million years, just my style of investing. I would never purchase Bank of America. I have Visa, so American Express is very unlikely. Coca-Cola, Kraft, Occidental, I don't have any gas stocks. And then you got US Bancorp, Chevron. Some of these names, just for my personal preference of companies that I follow and typically invest in, there are several names on here that would be very unlikely that I would ever buy as individual stocks. Switching over to Seeking Alpha, let's take a quick look at the stock today. These are the year-to-date results, plus 16%. Obviously, we've had some choppiness in the market. But as we take a look here, let's just say from February 25th, when the war started over with Russia and Ukraine, and consequently we saw oil prices go up, we have seen Berkshire take a sweeping move to the upside. So that part of the equation is interesting just from an eyeball perspective, that we've had a lot of conflict and a lot of concern in the market, and this is exactly at that time when Berkshire started to produce a sizable return, at least over this short period. Looking at the summary stats, 52-week range, you are trading at a 52-week high, give or take right now. EPS forward, $13.55. You have a forward PE of 25 that sounds incredibly low. But keep in mind that this is a financial services stock. I think they're even categorized in the insurance category. So my guess is if you compared them across their sector and category, they would actually be one of the higher priced stocks, believe it or not. But still, if you're comparing it to tech from a forward PE perspective, you'll find that Berkshire's 25 is certainly cheaper than a lot of other companies out there. And if we look right below that, dividend rate and yield, common misperception, I guess I would say, with Berkshire is that they do not pay a dividend. Berkshire B shares do not pay a dividend. And it's actually one of the attributes that a lot of people like who follow Warren Buffett, because you don't get taxable events, right? So every time you get a dividend, you are ultimately taxed on that dividend. So by fencing in the shareholder value within the stock instead of distributing it, you make the assumption that the core businesses go up over time and you don't get taxed until you sell the stock. So I just mentioned how many Buffett investors actually like that they don't get a dividend, right, for tax purposes. And that goes really well, except when you start to compound way too much cash, and we know what's happening with inflation, so there starts to become a decent amount of pressure on all cash holders to do something with their money. And in the case of Buffett and Berkshire, they are sitting on $88 billion of cash and cash equivalents as of December of 2021. Now, we just saw the recent headline on the purchase of Alleghany, and if that closed, I think it was like $11 billion on that last headline. But you can see here over the years, just from going left to right, this is 2016, where you had $27 billion, and you reached a recent peak, I guess, in 2019 at $64 billion. Last year, though, it was under $50 billion, and now you're right back up to 88. And even if we do the simple math on the Occidental and the Alleghany recent purchases, you're still in the neighborhood of $64 billion or so, at least on my math, of cash. So there's a lot of pressure when you're in these situations, and frankly, Apple, Google, Microsoft, all the huge cash cow companies face the same dilemma heading into a high inflationary period. Now, the other thing you can do with your cash, which we've seen with the cash cow companies, is buy back some of your stock, and that's exactly what Berkshire did in Q4. They bought $6.9 billion worth of stock. Okay, now with those buybacks, one of the things that it does in the trend line was something I called out in my last video about buybacks. You want to see revenue and EPS per share increasing, right? And in a perfect world, if it makes business sense, you want to see the shares outstanding start to go down. And while we're still early in this Buffett buyback era, that's exactly what you're getting here. As you can see on this bar chart, this is revenue per share. Then you have basic EPS. And finally, you have the weighted average shares outstanding. Now, that's a weighted average, and they purchased a lot in Q4. So since it is weighted, the dent that they put in Q4, at least for this bar graph, goes it does not given as much importance because it just happened at the end of the year. What will be interesting, though, is as we get into 22 through 23, is does Warren Buffett decide to buy more shares of Berkshire as we go on throughout the year? Okay, so a quick recap in terms of positives, in my opinion, of using Berkshire as a hedge to the Qs. Is you have more diversity into different holdings such as financials and oil companies and insurance companies. You also have a stock that doesn't have dividends, so in terms of taxable events, that could be seen as a bonus depending on your preference. Next, we have the stock buyback program, which in my opinion is good for increasing earnings per share over the long term. We also just saw a couple recent purchases by Berkshire for companies that have nothing to do with the Qs. One is an insurance company, Alleghany, and the other was a double down on the Occidental play. So those are all core positives. I think the biggest negative we have right now is the fact that at 43% Apple, is that enough diversity to truly make a hedge on the QQQ, which by itself holds 11% or so Apple shares? Okay, well, we can't predict the future, but we can certainly cherry pick the past to get a feel for how Berkshire has performed against the Qs. So this chart here on Seeking Alpha is a year-to-date chart. We've got Berkshire in orange, VOOO, which is basically S&P 500 in blue, and then the Qs coming in purple. By the way, if you're interested in learning more about Seeking Alpha and playing with some of the data that I displayed here, check out my affiliate link in the description. It gives you a significant discount on 1 year of Seeking Alpha Premium. Think you'll love it. It's a tool I use here on the channel all the time. Now, getting back to the chart, so this is year to date, and Berkshire's the clear winner, 16.81% versus the Q at minus 11%. So that's a spread in there of 27% that you would have done better if you bought 1 share of Berkshire Hathaway instead of 1 share of QQQ. So year to date, looking very solid. If we scroll out to the 1 year view, Berkshire's still winning, 38% versus plus 12% for QQQ. Now, where things start to get tricky is when you expand the timeline, right? So instead of just going year to date 1 year, you know, if we go back pre-COVID on the 3-year horizon, then you've got QQQ winning significantly, plus 96% versus Berkshire's 69%. However, I will say that Berkshire beat the VOOO by about 12% in that 3-year period. Now, if we extrapolate to the 5-year view, you got the Qs coming in plus 166%. You've got Berkshire plus 100%, which beat the S&P, which was at plus 87%. Now, to be fair, this is the last 5 years when we've seen a huge technology boom, and we've had the COVID crisis at play, which has really changed so many things in the investing world. Okay, so here I've changed it up. I moved it to the 10-year view, and it's pretty obvious how things look from the high level, right? So 425% return for the Qs, Berk at 329. But if we dig a little deeper, we can see that Berkshire actually did pretty good. Let's take a 1-year return to 2013 in March. You see the sort of scoreboard up there. Berkshire's winning 28% to the Qs at 3.5. Then if we go to the next year, somewhere in here, Berkshire's winning 52% to 36%. And it's not until we get to, well, not even 2015. Berkshire wins the first 3 years of this race, if you will. And it looks like maybe somewhere around December of 2015, QQQ takes the lead. But it goes back and forth here for several years, riding all the way up until right about 2019 is when the separation really begins, right? So you've got on this graph a 7-year stretch where, give or take, they were riding together. Sometimes you had the Qs on top, sometimes you had Berkshire on top, but then the Qs finally start to separate. And then obviously over here, as we're coming into recent times, it's interesting to see the Qs falling back down and Berkshire going up. What you may be able to argue is that Berkshire's a little bit more consistent in their growth, and the huge uptick that we saw in the Qs, which obviously outperformed Berkshire, we're starting to see that come down and Berkshire go up. So again, there's a little bit of predicting the future in there that's really hard to tell. Okay, so bottom line for me, looking at Berkshire as a potential hedge for the Qs, I don't really see it. I don't think that Berkshire is a bad investment, but if you were going to have, let's say, 60, 70% of your portfolio in the Qs, or perhaps you're buying into TQQQ like I have been a little bit at a time, I'm not sure Berkshire's going to give you the fundamental safety net that you're looking for, especially when Apple's at 43% of the portfolio. We know that Microsoft, Apple, and Google are sort of holding up the Qs from having way worse returns than they would. So I think with that in mind, while it's interesting to look at Berkshire, and that stock has a lot of positive things going for it, particularly over the long term, there's nothing really here that's going to get me to divert any of my Q dollars into Berkshire dollars. All right, investors, let me know what you think about Berkshire Hathaway. Do you own shares? What makes you buy it? Do you still feel good about the Buffett investing strategy here in 2022? As always, please give the video a like, share with your friends. Don't forget to check out that Seeking Alpha affiliate offer in the description. Save yourself some money. We will see you on the next video.